Good morning. This is your weekly update with Jim Stewart. I'm the Chief Investment Officer here at Worth Asset Management. Today is October 31st, 2022. Happy Halloween. And I'm going to go over your three threes for the week. I'm going to go over the top three market movers and economic data from last week and this week. I'm also going to go over our favorite three asset classes and how we are positioned on the short term for equities and for bonds. So let's jump on in.
Okay, let's go over the top three market movers for the week, October 31st, 2022. Number one, we had a nice monthly bounce, and also we're going to look at the Fear and Greed Index. And number two, we're going to look at the FOMC is meeting this week and their rate decision on Wednesday. And number three, our chart of the week, which is our monthly jobs number. All right, let's first go over our major asset classes performance for the week and on a year-to-date basis. For the week, we did have a nice bounce in some select equities. A lot of it had to do with the ones that went down the most actually bounced, like small caps, real estate, and Bitcoin, while the others were still up 1%, 2%, and 3%. The US dollar was down for the week, along with emerging markets and gold. But on a year-to-date basis, we still only have the US dollar and commodities as our positive returners, while everything else, including bonds and equities, are down double digits. So still not a great investing environment for 2022. All right, we're going to go over a little something new this week. We're going to look at the Fear and Greed Index. This is an index from 0 to 100, and right now we're sitting at about 60. So we're into the greed after a nice little bounce over the past month. But if we go back just 1 month, you can see that we were in the extreme fear back at 15. And because you typically want to take a look at that because you typically get a bounce, well, we did have a bounce. And we saw the Dow go up about 10.8. The S&P is up about 5. However, the Nasdaq's only at 0.6, and our bonds are actually down for the month. So it was very selective bounce that happened in October, and it wasn't widespread, but there was some areas that did have a very nice bounce for the month. All right, let's go over some of the economic data from last week. The big mover last week was the third quarter GDP, and it's being touted as we're not in a recession anymore because it came in at a positive 2.6. But let's go look at the numbers. And this is the last 4 quarters of real GDP. So you can see their numbers here. And here was the 2.6 for the first revision. But government spending, which again is inflationary, so every time the government spends, it is inflationary, was a big impact for this 2.6 number. As you can see, the last three times it was all negative. This time it came in at a whopping 2.4. So the government was spending, driving up that GDP. Also, because of the strong dollar, it brought down the cost of imports and brought up the exports. Okay, so these two numbers right here had a lot to do with why this was a big 2.6, because we were trailing at 0.5, 0.6, 0.7, and all of a sudden the last month it shot up. That's why it did. Now let's fast forward into the fourth quarter. Right now the first estimate is negative, which means so far in 2022, even though everyone's touting the economy's back, we're doing great, we have still seen no growth for 2022. All right, well, let's talk about the economic data for this week. We have another busy week for corporate earnings. This is the third now, where investors will get earnings from healthcare, Stryker, Eli Lilly, Pfizer, etc. They'll also get from 2 large auto makers, Honda and Toyota. And then we have some more energy companies coming out that are all scheduled to report this week. On Tuesday, we have the FOMC, their meeting, their day one. That's when they're starting. And then we have the JOLTS report coming out for September. And here's their number for last August. We also have ISM, manufacturing PMI, coming in right at the line at 50%. Typically, we're expanding when it's over 50 and contracting when it's under 50. So we're right there at the line. On Wednesday, though, will probably be the big market mover because we have our Fed funds rate decision, which right now is estimated to be a 75 basis point hike, which I'll go over in a second. And then we also have ADP private sector payroll. But here's a really interesting chart that goes over the last 6 moves that we have had, that Fed has had on their interest rate hikes. In March, we had 25 bips, in May, 50, June, July, September, and now in November, we have 4 75 basis point hikes, which is the most aggressive the Fed has ever been. And the last time the Fed funds rate was this high was January of 2008. So let's take a look at, now that we know that what they're going to be doing on Wednesday, let's take a look at what they're going to be projecting in December. Right now, the December 14th meeting, there's a 50% probability that they're going to do another 75 basis point hike to get us to 4.5 to 4.75. And there's a 44% chance they're only going to do 50. So the probability of them raising at least 50 is almost a certainty. And there's also, even if we fast forward out to February, they're right now projecting a 50 basis point hike. So we're going to get above 5% here by the time February 2023 rolls around. All right. So why is it a market mover? Well, here are the last 6 times the Fed has met and the S&P percent move on that particular day. Well, the first one wasn't a big mover, but the next 3 to 4 to 5 were, because 2% up in March, 3% in May, a 1.5% in June, a 2.5% in July, and then the first negative after the rate decision was in September, when the market was down 1.7 on the day that they announced. Now, I added the CPI in here because the CPI will be the market mover for next week. As you can see, the market does move a lot when the CPI is reported because that's our inflation gauge. All right, and our chart of the week, which is reported on Friday, which will be our non-farm payroll report for October, and it's estimated to come in 220,000 jobs versus 263 in September. But the thing is let's take a look at this graph of the last year, and as you can see, the trend has been going down. Okay, so we're still gaining jobs, but not as much. And the most important thing with this graph is to make sure that we stay above 200,000 jobs created for the month. That's the key. We've got to stay above that, because if not, then the recession fears and the talk of the Fed overdoing it will all of a sudden start to spark this market. Unfortunately, probably not in the right way. All right, so now let's go over our top 3 asset classes on a long-term basis. We have still T-bills, US dollar, and commodities are our top 3. So our defense is still on the field and the primary driver. However, I added a new thing to this chart because, it seems like we've been on defense this whole time. Well, if you backtrack to a year ago, this was our 3 top asset classes: commodities, NASDAQ, and the S&P 500. So as you can see, we were on offense a year ago. So we're not always on defense. So I will continue to add this, and so you will kind of get to see how we are moving throughout the year. All right, so let's go over our bonds on a short-term basis. We are still above the 4% level on our 10-year interest rates, and a year-to-date drawdown still at over 15% on our bonds. And as you can see, we are still in protect mode as of August 29th, even though we had a nice little bounce here last week. We still got to get up a little bit more before we even get excited about buying into bonds again. So we're still in protect mode on bonds. Equities, however, there has been a change. We started nibbling at a few equities last week. It hit our mark last week, and so we weren't necessarily buying the S&P 500, but there were some things that were more attractive, and we were nibbling. So our clients were seeing that we were actually nibbling and buying some equities last week. We shall see where it goes. We still have some major resistance zones that we've got to break and get through before we get the all clear to say, great, this time is different, and now we're going to start adding a little bit more on the longer term basis. But right now, it's at least a short term positive on the equity side. We shall see where that ends up. That's it for this week. Thank you again for joining us. Our next update is Monday, November 7th. And as always, continue to subscribe, follow, like our YouTube channel. And we will see you next week. Have a great week trading.